Hello everyone and welcome to the Property Podcast. I'm Rob B with, of course, Rob D, and this is episode 244. And this week, I'm going to let David tell you what we're talking about.
Yes, welcome to the Property Podcast. I'm Rob D, he's Rob B, that was Dave B, and we've also got Dave C joining us on this week's episode. It's almost like we've thought this through. We are joined today by mortgage broker extraordinaire Dave Cookson. He is going to be talking us through the many changes in the mortgage market. This is going to be a real must-listen episode. We give a bit of stick to some mortgage brokers. Sometimes we say how important a good broker is, and many of them are not so good. Dave is one of the good guys. He really knows his stuff, and we're going to be talking about loads of things that you need to know before you apply for your next mortgage.
And if by magic our news story this week is also related to mortgages, but we've not just eked out some news story that has minor relevance to us all, it's actually really important, particularly important for people who invest through limited companies, because for the first time, a major lender has come to the limited company market. And that lender is the Mortgage Works. And the Mortgage Works, for those who don't know who's behind it, is nationwide, one of the country's biggest lenders. So that's a huge moment for the limited company market.
Yeah, this is absolutely massive. This is not just any old lender throwing their hat into the ring. Nationwide is, if not the biggest, then they're certainly in the top two. They are huge. The Mortgage Works is their buy-to-let brand. The fact that they're getting into limited company buy-to-let means two things. Firstly, it means great. That's another product that looks really competitive from what they've released so far. The second thing is everyone else is going to be watching them. They're not going to want to lose market share, and I'm sure we're going to see others coming in as well. So who could have predicted something like this happening?
Well, we did. Oh. Rob, it's like you led me in. So our predictions episode at the end of last year, where we predicted what would happen in the property market this year, this was one of our predictions. So ding, we got that one right. We'll link to the show notes because we clearly want you to listen to stuff where we've been right. So we'll link to that episode in the show notes. But in a few weeks' time, we'll be making our predictions for next year as well. So make sure you listen out to that one. Another important point around this announcement is that service levels for limited company mortgages are not fantastic. They take a lot longer to get through than traditional buy-to-let mortgages in your own name. So hopefully the Mortgage Works coming in, they'll up that standard and everybody else will raise their game as well. So fingers crossed.
All right, let's get on to our topic of the week, where, as I said at the top of the show, we're very lucky to be joined this week by Dave Cookson. Dave is a mortgage broker who we work with very closely on a number of things. He comes to all our summits. The amount of knowledge he's got about mortgages is phenomenal, and now seemed like the perfect time to get him onto the show because there's so much going on. One of those things, as we've just been talking about, is the Mortgage Works. So we started out by asking Dave what the impact of the Mortgage Works coming into the limited company market would be.
Well, the impact's quite phenomenal, really. I mean, TMW, probably the second biggest individual buy-to-let lender out there, moving into a market where the lenders are not as strong as our high street lenders in terms of the amount they lend. It can only go in one direction, which I think is a positive direction, in that we may well see further rates in the future decrease, and more importantly, which I know you two guys know I bang out on about all the time, is that the service within the industry will improve. The limited company buy-to-let market, on average, from application to offer, if we do it in 6 to 8 weeks, is really good. We would hope the impact of TMW coming into that market is going to reduce that to around about 4 weeks, one would hope. The other positive impact I can see on the market is that now TMW have led the way from the individual buy-to-let market into the limited company buy-to-let market. It means that the rest will follow. And I foresee the largest individual buy-to-let lender, BM Solutions, following the direction of TMW, which, as I said, is a very positive thing.
Super. Okay, so Dave, I mean, if that was the only piece of news in the mortgage world, then that'd be plenty to discuss. But, of course, we've just had the rate rises, Bank of England moving the rates up. So what impact, if any, has that had on the mortgage market? What's that done for you, the clients that you work with, the products that you're looking at? What's played out?
It didn't come as a shock to us. I think the rate rise if I'm correct, was on the 2nd of November, we saw indications that was going to happen in the market as far back as September. Your larger high street lenders were putting rates up. Now, they didn't put them up to by 0.25% in the fixed market, but it was around about 0.12. So we knew it was coming. Obviously, the trackers have gone up by 0.25% because that's the nature of the beast. The interesting thing is, and we've just mentioned TMW, in the limited company buy-to-let market, we've not actually seen any huge, or I think we've not seen any huge interest rate rises, if any. And certainly we've seen some reductions in the rate in that market. Again, I think if we think of Keystone have just brought out a 2-year product at 3.65, which for a lender of their size is quite a remarkable thing, really. In that, their rates traditionally were closer to 4%. Now that's probably because they're linked to the LIBOR as opposed to the base rate. For those who don't know what the LIBOR is, it's the London Interbanking Offered Rates, and it's what the lenders borrow their money at. It's not had the impact I thought it would have, certainly on the buy-to-let market. And I think that's probably because the lenders have recognised that there are other detrimental things which are happening in the market. I would suggest, obviously we've had the PRA rental stress calculations go up. We've had the new tax implications which are coming into force as we speak. So I think they've recognised that any huge jump in rate would have an impact on their lending capacity.
That's really interesting, Dave, because one of the things we've said previously, because we've been asked this so many times, particularly Ask Rob and Rob, is when rates eventually go up, because of course they had to at some point, will mortgage products go up? One of the things we suggested may happen is competition would actually mean that those rate rises would be absorbed by the lenders and not passed on necessarily to the borrowers. And that's really interesting that already that's played out. And in fact, rates are getting better, particularly in the limited company market, where I suppose the margins are a little bit bigger right now, so they can afford to take a bit of a hit.
Yeah, I mean, that's a great prediction. Again, just if we just focus on the limited company buy-to-let market at the moment, the seismic shift of lending from the individual buy-to-let market to the limited company buy-to-let market has been huge. And I know I've spoken personally to you guys about this in the past, but the individual buy-to-let used to soak up 80-90% of all buy-to-let lending. And we've seen that with the savvy investor switch over to the limited company buy-to-let market. And I mentioned Keystone earlier, and I think I had a look at their report, and I think it was 12 to 18 months ago, they were doing around about 50-50. Now, Keystone are a limited company buy-to-let lender. That's their niche, and that's now at around about 85-90%. The forces within that market, because there is a smaller pool of lenders and they are absorbing the majority of the buy-to-let market now, means that they're in fierce competition. And again, I can only see rates going down. I know for a fact that they're struggling for staff because there is that much business. And we could speak to one underwriter at one lender one week, and that underwriter will be at the other lender the next week, and then on to the next on the other week. So yeah, your predictions have been spot on.
Well, Dave, one of the things that you touched on there in passing was the PRA rental stress test. So many changes. We've just talked about the mortgage works. We've talked about the base rate. One of the other things that's been going on this year is that stress test. We've covered it on the podcast before. The gist of it is that they're going to be testing rental income more strenuously to make sure that the rent covers enough to make your mortgage affordable. That's the summary of it. That came in January. So we've had nearly a full year of that. What impact has that had on the market, and how has it affected the clients that you work with?
The impact on the individual buy-to-let market has been phenomenal. That's why we've seen the seismic shift we have seen over to the limited company buy-to-let market. And now it's important to remember that the PRA rules, which came in January of this year, where they were doing 5.5% or 145%, were allocated to the individual buy-to-let market. Those rental stress calculations are not the same for the limited company buy-to-let market, where it's 5.5 at 125%. So what we've seen, and obviously I've already just spoken about it. What we've seen is a movement of lending from the traditional individual buy-to-let market move over to the limited company buy-to-let market. Not just for that reason, for tax reasons as well. Within the limited company buy-to-let market, the tax situation is far more favourable. But yeah, it's had an impact on one market, but it's actually made another market busier. The point to remember is that lenders want to lend, and that's why we've seen TMW move to this market, move to the limited company buy-to-let market, because the numbers they were lending 2 years ago have been severely affected by the PRA rental stress calculations and the tax position.
So following on from that, Dave, so many changes right now, but another change that we've talked about on the podcast this year is portfolio landlord requirements. So Dave, first of all, can you remind everyone what that is? But what we'd really like to hear from you is, how are lenders implementing that? Because it's so new. How's it playing out?
Well, you hit on the right note when you said new. Lenders are still adapting to it. This only came into the force, I think it was the beginning of October. Generally, what a portfolio or a landlord is considered a portfolio lender nowadays is if they have 4 or more properties, and they will do a rental stress calculation on those properties in the background. As it stands, there is not a rule that fits all lenders. Lenders will adapt themselves. Each individual lender, from a point of view as a broker, is implementing their own portfolio rental calculations, and every calculation we do online is different. The likes of Shawbrook are kind of continuing as normal. The likes of Virgin, it's a real strict calculation. And again, I'm starting to bore myself going on about this. The effects in the individual buy-to-let market are far more recognisable than they are in the limited company buy-to-let market. And the reason for that, I would suggest, is that within the limited company buy-to-let market, historically, they have dealt with the larger landlords. It would not scare them if you had 40 properties in the background, whereas an individual buy-to-let lender, that's not their norm. I think the individual buy-to-let lender, without trying to put too big a label on them, in my mind, we're not so much for the accidental landlord, but the one who used to dip their toe in the market and maybe buy 2 or 3. Whereas the limited company buy-to-let market traditionally was for your professional landlord. So it's had an impact on the market. We as a company are still trying to gather our thoughts on each individual lender. And the reason for that is that experience tells me that lenders will have a knee-jerk reaction to any regulation which comes in, be that the mortgage market review, be that PRA rule changes which came into play, be that the implications of the regulation on the portfolio landlord. Their knee-jerk reaction is to react quite strictly to the law until they recognise that they're actually not lending anymore. And then what they will then do is they will not so much relax, but work within the regulatory laws to establish their lending potential again.
So we've already talked about lots of factors that have driven people towards limited companies. We know from what you've told us and from what we've read in the press that the shift towards limited companies is absolutely massive. Lots of people who haven't gone down that route yet are thinking about doing so. I think the perception for people who are thinking about going into limited companies are that the mortgages are more expensive and that the process is more difficult. I know that there's change afoot, but at the moment, with things as they are now, how much truth is there to those, with limited company mortgages being more expensive and more hassle?
Without a doubt, if you just look at it on the face of it, the interest rates are higher than the individual buy-to-let market. Probably, if you're talking about a round figure about 1% higher. But what you've got to remember is that even though the interest rate is higher, the tax implications, if you went the individual buy-to-let market, actually that 1% is not relative. The difficulty in obtaining them is that there is a poor service offered by these companies because of the pressure on them at the moment. So the number of people going to them. I think it's also important to point out that there are differences between the individual buy-to-let mortgage and the limited company buy-to-let mortgage, and some similarities as well. But the main difference is obviously that you're going to be putting it into a limited company. And due to that, the lenders will ask for a PG, a personal guarantee. They will also, with some of them, charge you for their legals. So the likes of Shawbrook would ask you to pay for their legals, but then Precise don't. The way they're underwritten is very similar to the individual buy-to-let mortgage market, in that they're going to want to see a minimum income, not in all cases, but generally of around about 25,000, and the rental stress calculations would have to fit in as well. Again, on the positive side, I can only see that improving over the next 12 to 18 months. And I mean that on a service level. There could be a possibility of the PGs going. Arrangement fees, which I didn't touch on, arrangement fees are around about 1.5%. So depending on the size of the loan, a lot higher than you'd find in the individual buy-to-let market. But yeah, as I say, I can only see things improving as the larger companies move into that market.
Well, yeah, TMW moving in this week being a prime example of that. Dave, we can't have you on the show without picking your brains and just asking you what products are getting your attention right now, because the best rate isn't always the best product. So who's doing interesting things out there right now in terms of a lending point of view, whether it be through an individual buy-to-let mortgage or limited company mortgage? What are you seeing?
I just touched on limited company buy-to-let mortgages having 1.5% arrangement fees, and the products which is really jumping out to me at the moment is one with Precise, where it doesn't have an arrangement fee for a limited company buy-to-let, which may not seem strange in the individual buy-to-let market, but having worked in the industry for longer than I care to remember, that is quite a milestone, and it's a really good indicator of where the market's going. We predicted this as a company 12 months ago, that we would gradually see the removal of the arrangement fees within the limited company buy-to-let market. And that's starting to happen. And then all of a sudden, Paragon, I think it was last week, removed their arrangement fee as well. So as a broker, that's really exciting for me. Because 1.5%, when you say it out loud, doesn't really seem like an awful lot. But if you are buying, if you were buying quite a large property, and you've got an £800,000 loan, that 1.5% is a big, big number. And to see the removal of those arrangement fees is something really, really good. I'm not a fan of arrangement fees, I've got to say.
I don't think any of us are, Dave.
Well, when I started out, they were non-existent, and I shouldn't bite the hand that feeds me, but it was agreed on the bank's behalf. So to see them removed is really, really good for clients. Absolutely fantastic, because if you've got a £12,000 arrangement fee and you stick it on your loan, you've just got into a lot of equity. And so to see that removed is absolutely fantastic.
Well, it's good to hear that there are positive developments out there. So much is going on. So much has happened this year. I don't remember a year like it in terms of the sheer number of changes that are going on. So difficult to make predictions, but we're going to ask you to do it anyway. We're going to put you on the spot. How do you see the market changing over the next year? You've already touched on a couple of little predictions, but is there anything else? Where do you think we're going to be if we're talking again in a year's time?
I suppose we'll start off with regards to the base rate moving up. I don't see that happening in the next 12 months. I think they've put the rate up. They will see what the impact is on the market, and sit tight for quite a while. I may be wrong. There are people paid a lot more money than me to predict these things, but I think the base rate will stay the same. I foresee fixed rates, because of the base rate increase, becoming more popular amongst our clients and other brokerages. I foresee a lot more 5-year fixed products coming into the market. I think they are going to become more popular, certainly in the London market. And the reason for that being is the rental stress calculations have put a cut on the amount of equity you can take out. So as a broker myself, if I had a client down in London at the moment, because I don't foresee the rents increasing, you'll see capital growth, you always will, but to what degree we don't know. If someone came to me and it was a 65% loan to value mortgage, I'd probably be putting them on a 5-year fix. So I suppose that means, although we don't think the base rate is going to go up in the next 12 months, I think there's a little bit more uncertainty creeping into the market, obviously due to Brexit, etc. I see lenders reacting to that, and I predict the 5 years may well decrease. In general, across the market, residential, individual buy-to-let, and certainly limited company buy-to-let. And as you said, the biggest changes within the limited company buy-to-let market, and that's where I see the majority of changes happening. So we will see a little bit of a war between the lenders, and I foresee that on 3 fronts. The first one will be we will see further rates reduce in that market as TMW have come in, the competition increases. The service level, hopefully, will get a lot better. So instead of us telling our clients it will be 8 weeks, before you can get a mortgage offer from application, I'm hoping that will reduce to 4 to 6 weeks. And again, I foresee the arrangement fee of 1.5% not being removed, but realigned. And so we might see a standard fixed fee of £995. I think I've worked in this industry for 21 years, both in the finance and the property area, and I have never seen a more interesting market than what we are looking at the moment. There have been some seismic changes. It's a really, really interesting market to be in at the moment. And although the PRA rules and the tax changes come across as if they are a real bad thing, it's kind of opened up a new market, and I can only see that market going in one way, and that would be a very positive way.
Well, I know that mortgages have been a real pain point for investors recently because of all the changes, because of lenders having so much to get to grips with. But it's really positive to hear that things seem to be going in the right direction. Things are likely to improve, get quicker, which I know is a huge bugbear for people. And a war among lenders in terms of rates and fees can only be good news for the likes of us. So Dave, thank you so much for coming on the show. It's been great to get your perspective.
No, good chatting to you guys as always.
Super. Thanks, Dave. Well, we said Dave knew his stuff, and he really does, doesn't he, Rob?
Yeah, so much value in there. I hope you've been scribbling some notes. And now you've got that knowledge that you can use to plan, you can use it to take to your own broker, and you can generally feel clued up and confident. So that's awesome. Thank you so much to Dave Cookson. If you'd like to show your appreciation for the information shared on this podcast, even if it's not by us, but we're going to take the credit for a minute, you can leave us an iTunes review. Rob, has anyone done that this week? I hope so. I'll feel silly.
Oh, don't worry. Of course they have. We have wonderful listeners, and luckily many of them. This week, we've got 2 quick ones. Thank you to the following people. First up, Puppet Man says, I discovered the Property Hub podcast 3 months ago after reading Rob's book, Property Investment for Beginners, and I love them. I've listened to every episode while walking the dog, driving, and even at the gym. My week is not complete without listening to the 2 Robs' excellent advice, tips and tricks, and most of all, motivation. Keep up the great work. And actually, he gives his real name. It's Paul Smith Story. Thank you, Paul. And Gary from Dubai says, I find this podcast, the website, the books, the forum, all helpful and informative. The way it's presented in an honest, transparent nature with no airs or graces. Very refreshing, and I hope you keep up the great work. Don't worry, Gary. With reviews like that, how can we not?
Yeah, that's awesome. Thank you, Gary. Thank you, Paul. Really appreciate those. Let's repay you in the form of a resource of the week. And Rob, this is one that you found on the BBC.
Well, Rob, you'll be very, very happy because I found you, I promise this won't be every week, I found you an interactive map.
Oh my goodness, just when I thought a day couldn't get any better.
It's actually really good. This one I've actually clicked on. It's a graph that shows you how much of your area is built on. So it's really, really interesting. And it just shows you that, we say there's no space left in the UK, and there's a big debate of whether we should build in that space. But you can type your postcode in and find out how much space or how much area is actually built on in your area. So in my particular area where I live in Hertfordshire, 19% is built on and 54% is farmland. So it just shows you, you think, oh, it's quite a well built up area. And actually parts of where I live do feel built up. I must admit there is quite a bit of green area. But 19%, that surprised me. And here's the thing though, how does that compare to the rest of the country? Because I think I live in quite a green area. But the average of the UK is 6% built on. 6%. That's crazy, isn't it? Just shows you how strict our planning laws are. And that's because 57% of the UK is farmland. And again, never would have guessed that stat. So actually, while we love an interactive map, this is really interesting stuff.
Yeah, I'm not at all surprised to learn that in Islington, where I am, it's 86% built up and there's no farmland. Not a big shocker there. But if you'd asked me to guess what percentage of the UK was built up, I don't know what I'd have said, but there's no way I'd have said anywhere near as low as 6%. And over half the land being farmland, I honestly had no idea. So yeah, this is really interesting. So you can get over to the show notes to find the link to that one over on the BBC website. The BBC's coming up with some good stuff recently. You can find that at thepropertyhub.net/mortgage changes.
Now, hopefully, of all the years we've been doing a podcast, you've learned loads. But we've learned so much too, through our own experiences, through developing and investing, working with other investors, helping people manage properties, but also by teaching, we've learned so much. But the thing is, when you're on a constant learning journey, you come to the realization that some of your prior beliefs about property were just wrong. So next week, we want to highlight that to you. I know we're a bit nuts, but we do want to show you the things that we've changed our mind about. It's okay to change your mind about things in property. If you've learned more or experienced something differently, and now you're more experienced, it's okay to say, you know what, I used to think this, but now I think that. And next week, that's exactly what we're going to do. We're going to take you through all the things we've changed our mind about in property.
Let's be honest, Rob, the full brag about the predictions is ahead of us, and we're just trying to offset some of that. It's like a bragging offset scheme next week. We're going to be talking about the things where we've not been so right, and that's okay. We've got to take the rough with the smooth. Everyone changes their mind. We just happen to record everything that we think, so we can't really deny it. We might as well put it out there. But I think that's going to be a really valuable episode coming up next week. So we will see you back here for that next Thursday, and before then, we will of course have Ask Rob and Rob next Tuesday. So until we next meet, whatever you're doing, have a great week. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.